Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Small-cap stocks, like those tracked by the iShares Russell 2000 ETF, IWM, offer a shot at big growth, but they aren't for the faint of heart. These companies are smaller, nimbler, and often under the radar, which means they can skyrocket if they take off. Yet with high reward comes higher risk, from volatility to less available info. If you're looking for investments with explosive potential and can handle the swings, small caps deserve a closer look. The key? Smart strategies to manage risk without missing out on the upside. Let's break down how to approach them. What are small cap stocks? Small cap stocks sit at the sweet spot between established giants and tiny startups. Think of them as the scrappy underdogs, small enough to move fast but big enough to have some staying power. They're often overlooked by big investors, which means they can fly under the radar until they surge. That's where the opportunity lies, but only if you know what you're getting into. Definition and market capitalization range. Small cap stocks are companies with a market value capitalization between roughly $300 million and $2 billion. They're bigger than microcaps but still dwarfed by large caps like Apple or Microsoft. Here's how they stack up. Large cap, 10 plus billion, e.g. does Apple, Amazon. Mid cap, $2 to $10 billion, e.g. the Chipotle, Roblox. Small cap, 300 sam, the 2 baham, e.g. Shake Shack, Stitch Fix. Because small caps aren't household names yet, they're often more volatile. But that volatility works both ways. While risk is higher, so is the growth potential if the company hits its stride. Examples of small cap stocks and ETFs. Want exposure without picking individual stocks. The iShares Russell 2000 ETF, IWM, is the go-to small-cap ETF, holding 2,000 smaller U.S. companies in one basket. It's a popular choice because it spreads risk while keeping growth potential intact. A few individual small-cap stocks that catch attention. Crocs. Yes, the foam clogs. Went from meme stock to serious performer. Zscaler, ZS. Cybersecurity player that grew rapidly before graduating to mid-cap status. Chewy, CHWY. The pet supply retailer still fits the small-cap mold despite its loyal following. These stocks and ETFs appeal to investors because they offer a middle ground. Less risk than tiny startups, but way more upside than slow-moving giants. The trick is knowing when to hold and when to fold. Benefits of investing in small-cap stocks. Small-cap stocks pack a punch, offering unique advantages that bigger companies can't match. While they come with more volatility, the trade-off includes higher growth potential, hidden opportunities, and portfolio diversification. Here's why these under-the-radar stocks might deserve a spot in your investment strategy. High growth potential. Small-cap stocks often outperform their larger counterparts during market upswings. Unlike lumbering giants bogged down by bureaucracy, smaller companies can pivot quickly, seize niche opportunities, and scale faster. Think of them as speedboats compared to oil tankers. They maneuver easily in changing markets. A few reasons behind their growth edge. Niche domination. Small caps often focus on underserved markets, allowing them to grow rapidly before competition catches up. Easier scalability. With fewer layers of management, decisions happen faster, and innovation isn't stifled by red tape. Room to expand. Starting from a smaller revenue base means even modest gains translate into impressive percentage growth. Historically, small caps like Monster Beverage or Decker's Outdoor, OGG's parent company, started small before exploding into household names. The trick is spotting them early. Lower analyst coverage. Big investment firms and analysts tend to focus on blue-chip stocks, leaving many small caps under the radar. Less coverage means fewer eyes scrutinizing financials, which can lead to mispricing. For investors willing to do their homework, this creates prime opportunities to buy undervalued stocks before the crowd catches on. Why this gap works in your favor? Undiscovered gems. Without heavy analyst influence, stock prices may not reflect true growth potential. Lower competition. Fewer institutional investors mean less price volatility from large buy-sell orders. DIY advantage. Researching smaller companies yourself can uncover hidden value. Wall Street overlooks. The catch. You'll need patience and due diligence. These stocks won't always have ready-made analyst reports to lean on. Diversification advantages. Adding small caps to a portfolio isn't just about chasing growth, it's about balance. These stocks often move independently of large caps, providing a hedge when big companies stagnate. They also expose you to sectors and trends that don't always show up in the S&P 500. How they diversify your holdings. Sector variety. Small caps dominate industries like biotech, regional banking, and specialized manufacturing. Market cycle performance. They often thrive early in economic recoveries while large caps lag. Reduced correlation. When tech giants dip, a small cap energy or healthcare stock might hold steady. ETFs like IWM make it easy to spread risk across hundreds of small caps without betting on single companies. The result? A portfolio that doesn't rely solely on mega caps to drive returns. Risks of investing in small cap stocks. Small cap stocks can deliver outsized returns, but they're not without their pitfalls. The same factors that make them exciting, their size, speed, and under-the-radar status, also introduce risks that larger companies typically avoid. If you're considering small caps like those in the IWM ETF, understanding these risks helps you invest with eyes wide open. Higher volatility. Small cap stocks are prone to dramatic price swings. Unlike blue chip stocks that move in slow, predictable patterns, smaller companies react sharply to market shifts, earnings reports, and even rumors. A single piece of news, good or bad, can send shares soaring or plunging in a matter of hours. Why the roller coaster ride? Thin trading volumes. Fewer shares changing hands means prices can jump farther on smaller trades. Speculative interest. Traders often pile into small caps hoping for quick gains, amplifying short-term moves. Economic sensitivity. These companies lack the financial cushion of big firms, making them vulnerable to downturns. For example, a small biotech stock might surge 50% on promising trial results, then crash just as fast if the FDA raises concerns. If you can't stomach wild swings, small caps might not be your best fit. Liquidity challenges. Buying or selling small cap stocks isn't always seamless. With fewer shares available, large orders can move the market, meaning you might pay more to buy or get less when selling. Unlike Apple or Microsoft, where millions of shares trade daily, small cap stocks often have limited liquidity. Key liquidity risks. Wide bid-ask spreads. The gap between what buyers will pay and sellers will accept can be much larger than for big stocks. Slippage. Trying to offload a big position, you might have to sell in smaller chunks, pushing the price down as you go. Market hours volatility. Outside regular trading hours, liquidity dries up, making after-hours moves even wilder. This is why ETFs like IWM can be safer. They pool hundreds of small caps together, easing liquidity pressure on any single stock. That's a quick look at what makes small cap stocks exciting. But there's more to learn about managing risk and making smart choices. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.